Good afternoon, everybody. Welcome back to the Schwab YouTube channel for our next topic, building a stock portfolio. I'm your host, Kevin Horner. Thanks for being here today, everyone. You know, the market gave us a bit of a bounce on the heels of some positive comments out of Iran this morning, or this afternoon, rather, following some positive developments overnight. So we'll see to what extent the market might be capable of carrying this quick bounce that we've seen into tomorrow's open. So we're going to talk about a couple of levels as we kind of set the table for tomorrow morning, what we hope to be the open we get out of the broad indices here. And then we're going to take a look at our example portfolio, make some adjustments along the way to our existing example trades, and of course, review example trades we tried to place last week and a couple of new example trades for you as we head toward the end of this quarter. Or really, it's going to be, I guess, the beginning of the next quarter by the time we get those new trades in. So that'll be for tomorrow's business and completing up the short week. So with that, say hey to my friend Connie Hill in the chat. Connie, of course, is a fellow Schwab coach. She is a CMT as well, a chartered market technician, fantastic coach and analyst, and someone that you could ask questions of in the chat there. She'll get to questions and comments I'm unable to, but I'm going to keep an eye on things as always, try to bring your discussion topics into our chat here today. So please don't hesitate to drop those into the Q&A for us for the next 40 plus minutes or so. If you're not already doing so, make sure you're following Connie and me on X, Connie Hill CS, Kevin Horner CS, the easiest place to find us when we are not hosting for you here live on the channel. Okay, with that, let's get to our disclosures and then we'll move into the discussion for the day. Please bear in mind that our conversation here is exclusively informational and educational. We do not make recommendations nor any endorsement for a specific approach to trading the market. We do discuss technical analysis in this class quite heavily, actually. We offer up concepts, ideas, strategies traders may choose to employ through their own process. But of course, we discourage you from basing your decisions exclusively off what you get in the way of technical analysis. Though we do think it can absolutely aid us, we just don't want you to be basing or making your decisions only from technicals. Now, we don't commonly rely on options in this class, but I do want to point out that if you're thinking about options and knowing that we trade in a paper money account, there's some differences there that you need to be aware of. And when you trade options in paper money, you'll never be assigned early on any of your short option trades. But of course, in a live world scenario, that is absolutely possible. You can be assigned on any short option, whether in the money or out the money at any time. Remember, selling options means that you have an obligation, not a right. So you are not the deciding factor until you choose to close out your trade. Now, that can always happen in real life, but in paper money, you will never be assigned early. So that is one of the big differences between the two platforms. Please bear that in mind. All right, and that's the disclosure that kind of works that that note that I've just hovered and given you the reminder of. So please do keep that in mind here as we expand, and we're going to look at the S&P to see how we finished out the day here. So let's kick it off with the SPX. I'm going to bring that chart up, and we'll see that what we've got today was a nice, big, beautiful candle. Of course, some traders would look at today's candle as maybe the beginning phase of a possible rally over the course of a couple to a few days. We'll see how that plays out. But the key level today was working through the high we made yesterday. And then we had another key level above us that was taken out mid-session, and that was the gap zone. So we got into the gap and kept going. So traders, if you were kind of assigning bounce levels for yourselves, then you might have found that there were instances intraday where you felt a little more comfortable about putting new money on the table. We are, as of yet, undecided. It's way too early to know Is this the best entrance for us? Is this the lowest low that we're going to have in any pullback in the near run? Or is this merely a bounce into what has been resistance for us? I want to point out we have been below the 20-day moving average since here. This day is February 27th. And I like to cheat, draw my line from that day to today. Now the SPX from the close or the high on that day to the high today only down about 5%, but the more important factor is the 23 consecutive days below that moving average. So, we are getting a little bit lengthy, and yet the reminder is that in trending markets, the trend is more likely to continue than to break. So very often what a bullish trader is thinking about today, as nice as the candle was, is, hey, any rally that gets us into the confluence of the downsloping 20-day moving average in orange into former horizontal support, now potential resistance at the 200-day moving average, this represents an area for potential profit taking. Now, that doesn't mean we can't move through it, but you traders know how uncomfortable we can be in these instances if we are ill prepared. So as much as we want to buy into today's optimism and buy into the belief that we have got a low for the year in place, way too early to call it as such. And I think traders need to be at least expectant of any rally that pushes us into the 6,600 zone as being potentially sold. Okay. Now, that doesn't mean we can't clear it. It just means that initially, the first level of resistance we got to get through is pretty much this 66 and a quarter up to the 200-day moving average, which is just shy of 66.40 today. That gives us a lot of levels of resistance, and I'm sure you're not shocked by that, everyone, because as the market resets and moves to lower levels, well, then along the way back up, we need to have those stairs that allow us to know where we're going to set our risk along the path, right? So my hope is that we obviously, the best case scenario would be an open tomorrow that clears the 200-day and stays above it all day. That would be an unbelievable development. And it still doesn't mean that we are fixed by any stretch, because any rally through my oval zone here could easily lose steam at the next layer. But guys, this is what we're trying to accomplish. We're trying to understand what is the next price move? Where is directionality going to continue or change? And we have to be kind of prepared for a multitude of scenarios to play out. And that's really the reminder I want to give you, not so much the reminder from a building a stock portfolio class as much as how to look for things to finish out tomorrow and Thursday. Remember, markets closed Friday. Tomorrow will be the first day of the new quarter, and it's not really a surprise that we got a rally today on the final day of the quarter. I'm sure there were going to be some traders and long institutional investors looking to take position on the final day of the quarter, but we're going to see to what extent today's rally has any legs, and it's going to really play out over the next 1 and 2 day sessions. So very important day tomorrow. If you're feeling a little uneasy, you're not alone. But I will be here at Market Open tomorrow for Trader Talk in today's market. And of course, tomorrow being Wednesday, that means I'm going to be joined by my friend Brent Moores, and he and I will walk you through the open. We'll evaluate, we'll give you what we know in the way of headlines, and we'll have this same conversation tomorrow morning. Hopefully, it'll give you some areas to monitor and keep an eye on so that you know how you want to position yourself one way or the other. Okay, let's take a quick look at the NASDAQ. Had a big day today, 3.4%, rallied right back into resistance. I say resistance because you all know we fell through the green line. It really should now be colored a red line. And the technical view here, as always, is former support can now act as resistance. And now we're going to see if that plays out. So can we get through the red line tomorrow on an open? If we do, can we get through the 20-day moving average? Maybe the 50-day is the most important. As you'll notice, the last couple of peaks have actually been through the 20-day, but I saw both Wiley and Jay Richardson both talking about the potential Horner rules as it applies to your movement through these moving averages. Just remember, when we look at trying to validate breakouts here, many traders are looking for more than 2 consecutive closes above the resistance zone. So if we're watching the 20-day, 2 days above it does not necessarily break the trend, does it? We might need 3 days above the moving average. We might need a week above the moving average. But ultimately, what I want to remind you all about, as many of you were pointing out to this point, the reversal is unclear as to whether it has legs, and we traders can get bogged down by near-term data and ignore somehow the bigger development, the longer range trends. So try not to do that. Force the market to make its moves first, and then we start to believe once we see confirmation. Along the way, we haven't had a lot of confirmation over the 20-day moving average. We've had 2 days, 2 days, and 2 days, but nothing more. So maybe if we can get a third or fourth consecutive over the 20-day, we can start talking about the potential for higher lows and a new uptrend playing out. But we should not be surprised at all by big swings here. 3% on the SPX, 3.5% on the NASDAQ, 3.5% on the Russell, 6% on the semis. We should not be shocked, because volatility will often breed volatility. So big swings back, but that doesn't mean that everything is fixed. So always with a grain of salt. Let's look briefly at our Russell, our small caps bouncing off the 200 days. So could we say that we've got a little relative strength out of the Russell because it's holding the 200? We could, but again, you're going to hear me say the exact same stuff, everyone. Nice big candle above the high of our low day. However, we're fast at the 20-day. So can we get through the 20 on an open tomorrow? Can we maybe open in the vicinity of the recent highs, kind of in this zone? And maybe we can push into the 50-day intraday tomorrow or into Thursday. That would be amazing development. But I'll tell you, I'm a little bit pleased by what the Russell has done, considering the 10-year yields remaining elevated. The fact is, we've tested 4.3 on today's throwback move. So very important level. Obviously, if we're bullish in the Russell, we want to see yields coming down. But the data points we've got to work with in terms of high oil elevation, in elevated inflation numbers via recent data from PPI and CPI, and of course, oil staying elevated longer is not great for inflation either. All of which is having a negative impact on the yield situation, because as yields are rising, that's due to the fact that traders are selling U.S. Treasuries, at least on the 10-year note. So all of which is to say much of the same stuff. A lot of uncertainty, still a lot of headwinds. Let's hope we can get some clarity over the next couple of days. But I agree, Gary, nothing really has changed much. So let's not get too far ahead of ourselves. Okay, now with all of that said, everyone, let us take a quick look at the 2 positions we did attempt to buy last week. And this really is an example of what can absolutely happen here in a difficult market. And we are certainly difficult market. We're going to look quickly at our STX position we put on a week ago tomorrow. So we did place a buy order with the belief that we could get in and hold our 50-day moving average. That did not occur. So let me show you what did occur with our account statement. So I'm going to change this to STX, and you're going to see quickly here that unfortunately we did get in right away on the subsequent morning. 1 minute after market open, we were able to buy our 15 shares, and then we were executed 5 days later. We got stopped out 364.83. That happened on the 30th, just yesterday. The low yesterday was 351.42. So, the truth is, we gave it enough of a berth that we couldn't necessarily have kept yesterday, held it yesterday, given the significant drawdown it got. So we got stopped out. Part of the game, right? That's the cost of doing business as a trader. Unfortunately, in this instance, it could be a trade that we might want to revisit. It sure was a wonderful setup, but in the near run, we're going to force this one to get back above the 50-day moving average before we give any consideration to whether this trend is really reasserting. It's still unclear on STX. So unfortunately, we did take a loss. We had 15 shares. We lose somewhere in the neighborhood of $40 a share, so about $600 total on that. Not great, not wonderful by any stretch, but within our tolerance for risk. Everybody, as you can see, we are willing to own stock positions where our maximum loss is less than $1,000. We build in the number of shares to buy based on this information as well. So that's exactly within our comfort zone. Do we like getting stopped out? Of course not. But at the same time, we lost what we were comfortable losing. And I think that's really an important takeaway for those of you who might be new to this class in particular. Building a portfolio, yes, we want these stocks to hold. Yes, we want to maintain these positions. But as always, getting stopped out is just the cost of trading. That happens to us, and we can learn something from it. I think the best thing to learn, based on what we saw with STX and what we're likely to see with JCI, Johnson Controls here, where we took about a $9 a share loss on 70 shares, so right around $600, $630 by the math, is that we did the right thing. We built the trade properly. Did we like that we got stopped out? No, but we built the trade with the intent of exactly that, getting stopped out if it seemed like it could break down. And Johnson Controls is no different. It broke our comfort zone. And so we did get stopped out. Now, made that new lower low yesterday with a big ugly candle. And of course, that led to the exiting of our trade. And once more, we're going to force this to get above the 20-day before we start really thinking about it once more. But hey, it happens. So let's talk about the trades that we do have in the account that have stuck with us over the last few weeks. And then we're going to work our way into new examples for you all. Okay, so the first one we're going to peek in on here, go back to our account activity and positions. Let's take a look at Halliburton. We're going to like to do that. We've got a winning trade going at the moment. We're up about almost $1,000 on the trade. So let's take a look at HAL and see if there's any reason for us to make any adjustments here. So go to our chart, and there's Halliburton. All right, now we've got a bracket order working on Halliburton. So let me just shrink this down so you can see it. Boy, we came close intraday there yesterday with the high. The exit we've got on this, on our target exit, is at 41.50, and yesterday's high was 41.18. So we missed it by about 32 cents there. Now, we have a stop order below our 50-day moving average. And the question now, everyone, is do we want to raise that stop? Our 50-day moving average has gone higher in the last week because all of our prices in the last week have been above the 50-day. So we can expect a little bit of an adjustment here if we would like to take advantage of it. We don't have to make an adjustment, but many of you traders will do just that. Make the adjustment either every day, every week, how frequently you might look at it. I think it makes sense. It's a week later. Let's just go ahead and run the numbers. So we've got HAL at a 50-day moving average of 35.21. And now we're going to go ahead and add in our average true range for calculation purposes. ATR is $1.34. So let me make sure I've got that accurate here, everybody. I'm going to go in here to, yeah, that's supposed to be Wilder's ATR, I think. There we go. That should be the, I think it's all going to come out the same. Yeah. $1.30, let's call it $1.34. Okay. So all we're doing, everybody, is real simple math. We're taking our amount, our 50-day moving average at 35.21. And we are going to reduce that by the amount of the average true range to get 33.87. Now, I'll remind you that the average true range is just a calculation of the volatility that the position has seen. You should notice as I raise this this pane a little bit, so basically on a year-to-date basis, everybody, the range that the stock has seen is increasing, right? I should point out the elevation to this slope. So we're getting more volatile as we go forward. That volatility can be good, but it also can mean bigger swings, as we know, and we want to be profitable for as long as possible. So we're just going to raise that stop order to the 33.87. Currently, we're in at 33.26. So this is an effort to capture about an additional 60 cents, excuse me. But we have to remind ourselves that there's no guarantee that we're going to capture that additional amount because we have a market order to sell once we trigger. Okay, so I'm just raising this up, and this is now going to ask me to verify it here. So we're raising this to 33. I want to make sure I stay under 87. So we're going to go a little bit lower here just to be certain. 33.83. How's that? That'll give us just enough of a wiggle room. And again, if we get stopped out, then so be it. But we're just working to mitigate our potential downside risk here. So 33.83 becomes our new stop. Make sure it's on all 275 and send. Now, I did see a question here. Yeah, good question about should we consider selling maybe just a portion at our upper level? Well, in this case, I mean, we could. We built it to sell the entirety of the position, and maybe along the way, depending on how things go here, we could make an adjustment. I think we let it go. Let's see if we can't turn this one into a fully profitable position. And that level that I've drawn in, there's a reason for us targeting it, and that's because we've got highs up there from historical levels, everybody. This is a weekly chart that's actually the maximum weekly. Let's go ahead and just make it 5 years, be a little bit more obvious. So yeah, see how we didn't quite get into the rectangle or very, very close to it? Hopefully we get into that rectangle here, all right, and that'll give us our exit strategy. Hopefully we can move out. And then if it starts or continues higher, if it starts working above 43, then that becomes a level where we may reestablish a new position, right? Remember, breakouts are, especially new highs in a short-term window, new highs are not bearish. So we look at that level, we take our profit opportunity if we can, and then we reassess. And if it means that we have to sit on our hands and we let it break out through 43 and then we put a position back in, perfectly fine by us, right? In such a case, everyone, we're trading the momentum opportunity by waiting for it to close at new highs. In this case, that would be highs not seen in more than 4 years. So if you break out through highs of the last 4 years, that's a significantly bullish development. We want to see that. That's why we're more than happy to take our profits on this trade if we just get into this zone. It is true that some traders would say, hey, if we get in there, I'll sell some so that I can reinforce my positive behaviors, but I want to stick with some more. I want to sell a little, keep a little. That way, if it rallies, I'm good to go. I can still participate. And if it doesn't rally, I was smart to have sold some as well, right? That's why some of you traders are like me a little bit. You like this idea of selling a little and keeping some, right? Because you're right either way. You're right if it's the highest it gets, you were right to have sold some. If it breaks through it, you were right to have kept some. You're right on both ends there. So so there's the Halliburton deal. Let's peek in on, just make sure I got that adjustment in. Yep. 33.83 adjustment made. All right, let's check in on the Fastenal trade, everybody. Let's jump to FAST here. So just note we have one position in energy, one in industrials, one in staples, and this was intended to be utilities, but it shows up as others. We're going to check on the Fastenal trade here. Oh my goodness, guys, look at this one. We did pretty well. Our stop here is 43.18, and we missed our stop order a couple of weeks back. So we did a good job by placing our stop where we did. Now we've got Fastenal running through the confluence of the 20 and 50-day moving averages. This could be a new level of short run support for the position, and we might wish to make some adjustments here. So our ATR on this one is $1.13. And next up, the question is, which moving average do we want to work with here? Do we want to consider the 200, which is, of course, a lengthy moving average? I think if we're trying to stay with the position for as long as possible, it's probably the 200-day. So the 200-day is 44.56, and that means our stop would have to get raised to 43.43. Currently, we're in at 43.18. So I'm going to click, I right click on that red stop detail, click cancel replace, and I'm just going to raise it right here, everybody. And again, I recognize that some of you would wait for a bigger move. Some of you are always trying to capture any additional upside. It's entirely at your discretion. What we want to focus on is process more than anything else. So we are elevating it based on the 200-day moving average, less the amount of the average true range. There we go. So now we've got a new stop level that we hopefully don't even revisit, right? Okay, next, how about our Archer Daniels? This one's working okay for us as well. Let's take a peek. This one in the staples sector. Now that's interesting. How did we get... Oh, I know how, because that week, that's more than 2 weeks back, and the stop order elevation that we made last week took us through that low. So yeah, ADM is working fine. Hasn't broken out, you'll notice, everybody. Let's kind of revisit this chart just for a quick second. Many of you are going to note that we've got a number of tails up here, don't we? And the fact is that we have not been able to get through about 70, let's just call it 78. That's a pretty important level here to get through. If we can get through 78, then it's going to be viewed as more upside. This is really not bearish at all right here, but you can see that we've still not managed to close over 74 just yet. That's going to be a very important level for us. So now the 50-day moving average absolutely is rising quickly because all these recent prices are above it. So let's make our adjustment here. 50-day is at 68.74, and our ATR, let's bring that back in. I hope you all see how quickly, the way that I navigate this. I mean, again, it doesn't mean it's right. It's just the way that I choose to navigate, and utilizing the My Tools bar up above. Now that little hiccup we had on the My Tools thing has been fixed, this is a really easy way to speedily add in the criteria you're looking for, everybody. So give some thought to using this My Tools section. I certainly find it to be quite helpful for me. We are going from 68.74, our 50-day, minus the $2.44 ATR. That means our new level is 66.30. And currently, our stop on Archer Daniels is at 65.45. So we're going to elevate this one by just a little, about 85 cents. So I'm going to go in here, kick this up. All right, 66. How about 66.28? I always like to get off of those round figures where we can, everybody. So we will hit 66.28 as our new stop. Remember, these, again, don't guarantee any price for us, unfortunately, but how did that happen? 66.28. There we go. All right. but this does mean if we get down to 66.28, we get a market order to sell, and then we take that market order. That does mean it doesn't have to be near 66.28. It can be higher, it can be lower. If that's something with which you're unfamiliar, everyone, the explanation of a stop order is something we brokers have built an elevator speech on. All of us who talk to clients frequently have to know that pretty well. So if you're looking for some clarity or some color, some context, call in, have a discussion with a broker. We're available for you. Maybe not us, coaches, but 24/7. We've got training specialists available for you to have these types of conversations. Don't hesitate to call in. As a client, as a representative who's on the phones like that for more than 15 years, those conversations are necessary. So we're happy to have them with you. Please don't hesitate to do that. Okay, so we've elevated the Archer Daniels order. We also have an exit strategy on Archer Daniels up here. I know that some of you might want to see this one just be left alone. We certainly could make that adjustment along the way at any time. If we wanted, we can go in here and do a cancel, replace, and change from 100 shares to maybe 50 or 25 if you were so inclined. All right, and then our last one here from the example portfolio is the American Waterworks. So let's check that one out. AWK, we've got our stop. Oh my goodness, look at how close this one was, everybody. We just got into that one. Our stop is at 131.47, and the low on this day was 131.52. Now, I love pointing out when our stops are close to the low we see. And it just only because it's a great reminder of what our effort is leading to. Our usage of average true range is designed to keep us in the position to reduce the likelihood of us being stopped out on what I refer to as simply broad market weakness. We don't mind a trade going against us, particularly when it happens to be tied to company-specific situations. Bad earnings report, get out of that stock if it trades under your stop, obviously, right? So something changes in the company, a bad news headline, any of those details are good reasons to get stopped out. Bad reasons to get stopped out are, well, the market was questionable on a day or two, and volatility was terrible, and it took us out of a position that we really wanted. But that's what ATR is trying to do. Now, I can't tell you that 1 ATR or 1.5 ATR is going to keep you in your trade every time. There's just no way to do that, right? And there's no way to do anything like that as it relates to technical analysis, because nothing works 100% of the time. It's all about probabilities. You all know that. So our goal is just to use ATR to increase the likelihood of us holding that position longer and not getting stopped out on broad market moves, but rather significant moves from the underlying stock itself. I hope that makes sense, everybody. So AWK, we're going to keep that stop where it's at. We've moved a little bit higher, but ultimately, I think the plan for this one, as I back this out a little bit, everybody, is going to be, can we get above our downtrending line? And if we can get above our downtrending line, we then have a lot of reason to elevate and raise our stop order. In the meantime, let's go ahead and stay cautious here, right? If we get beaten back and trade under this ledge and we get stopped out, so be it. But ultimately, if we can get through the white line, then we have a much better opportunity for this trade to work in our favor. So we will wait to see if we can't get some broken down trend line and a rally through that'll allow us to really elevate and raise that stop order. Okay. Yeah. Hey, this is what I'm liking to see, Kelly. Absolutely. Your ATR trail stop setting is 3.5 ATR. You know, that is a wide berth, and that's exactly the idea that we're striving for. Again, my job is not to tell you what those specifics need to be, but rather that you need those specifics to aid you in making your decisions, right? We need these rules of thumb to make our decision making easier in the moment when we are trying to make a decision kind of on the fly, right? That's exactly what this is all about. Reinforcing positive behaviors, doing them consistently, staying true to our plan, not allowing emotions to override. Okay, so there's AWK. We're going to stay the course there. Now, in looking for opportunities today, I thought it might be intriguing to take a look for a particular group that has been killing it this year, energy. And the reason that becomes interesting now is because of how energy looks. So here's energy. Let's put up all the moving averages. There's your 20-day. We're still a bit of a ways away from the 20-day, right? But what if we decided that we want more exposure to the leading sector year to date? Because as good as today was, there's nothing to suggest that we couldn't continue to see elevated oil prices pressuring the US stocks. And if that's in fact the case, well, then we might have opportunities to be buyers of energy stocks at or near support levels that would make it a good entry opportunity. So noting that that we're trading above the 20 days still on energy, we've really had 2 limited down days. I thought we'd look in that space, and it's a good reminder, everyone, that when we're buyers, it's great to be buyers on down days. I know human nature wants you to be buying when you see those numbers in green. That's just the way our brains work. But if you look at some of these, you're going to find some interesting opportunities. Could we place a buy limit in the neighborhood of the 20-day moving average? What if weakness in energy tomorrow at the open, which continues to give credence to the idea that we've got possibly some upside in the broader markets, we could open weekly in energy and get ourselves in at an area of support. So maybe EOG near the 20-day, or Apache near the 20. Let's see, how close are we to that? No, still pretty far away. That one's 5 points away from the 20-day. Goodness. What about Devon? Similar here. It's a little bit closer, more like 2.5 points away. OKE, okay, now that's closer, everyone. Look at that. We've had the 20-day has been working. Now, so here's a thought. What if we went with OKE, recognizing that we might be able to get in near the 20, but look at how it's been a little more porous as far as support is concerned, right? We've had some action along the 20-day. It hasn't automatically held for us. What if we split this up? What if we said, let's buy a portion in the neighborhood of, say, 88.5, right? That would be above the 20-day. And we can put an exit below the 50, because it sure feels like the 50 should offer support even if the 20 doesn't. So noting the 50 crossing the 200 to the upside, we gotta have to give it a little bit of a wider berth here if we choose to use the 50-day and a measure of the ATR, but I think that might make sense, everybody. What do you all think? Do you all agree? I mean, if we try this limit in the neighborhood of, say, 88.5, basically today's low, essentially, put us in it and then put an exit, ATR beneath the 50-day moving average. That's kind of what I'm leaning towards. So let's see how that looks. The question, I guess, is what size of our position do we consider, right? If we are buyers at 88.5 and we're using the 50-day, 84.35, less our ATR of 259, well, then our exit comes in at 81.76. That means we're risking just shy of $7. Okay, so $7 relative to our $1,000 maximum. We could own 100 shares here, but I kind of feel like maybe we do a smaller 50-share position. And if we revisit, let me just give you an example of how I might like to give myself some options available. If we were able Let me put in a line at just shy of 81.76 so I can highlight where that is. So this is approximately where our exit would be on a stop order, okay? But what if next week we reconvene, we're in shares, say 50 of them, we've broken the 20 but held the 50 essentially? We could be able to add down here nearer what we believe to be a supportive 50-day moving average. That wouldn't be terrible either. So this way, it gives us, as Ricebird is mentioning, I love this, inch in with this market. Don't get crazy, right? So let's do 50 to start us off with an exit below the 50-day, and then potentially next week, everyone, if this keeps rallying, cool, maybe we add on a breakout, or maybe it sells down to the 50-day but doesn't stop us out. Maybe we add after validating the support at the 50-day. So let's do 50 right now and potentially 50 later. Okay, so I think that might work, but we're going to, obviously the market's going to tell us whether there's any legitimacy to this idea. We will go with an entrance with a stop. We will not do an exit strategy to the upside, only protective to the downside. And our goal is to put ourselves in this as long as it's under 88.50. Okay, remember 88.50 good for tomorrow. Let's leave this just good for tomorrow. Let's see if we can get this one executed tomorrow. 88.50 or better. That means lower. So we would need to open lower tomorrow to get this one hit, or trade under 88.50 at least at some point tomorrow. And again, the reason that we're looking at it like such is because if the rally we got today at the open continues, then there's a better chance that oil, or excuse me, energy broadly is weak tomorrow. And if that's the case, that gives us a chance to get into a weaker energy day to get into our underlying position. And here I'm making our stop order 81. The number was 81.76. I'm going to go beneath that. Let's go to 81.68. That just gives us a little bit more wiggle. Okay. And that has to be good till canceled. And again, we're doing this only on 50 shares. All right. There we go. Make sure that the sell is also 50. It is. Hit confirm and send. Buying 50 OKE at 88.50 or better. Subsequent to that, we'll have an exit strategy with a good till canceled stop at 81.68. That's just a trigger. If we get hit at 81.68, we get market price thereafter. We have gap risk. So, you know, if we opened one day, closed one day before it above 81.68, but opened the next day at 75, we're going to execute close to 75, not so close to our trigger of 81.68. So just keep that in mind. All right, there it is, everybody. So, that white line was right on the money. How about that? Okay, so we have placed a new order for tomorrow. The hope is, of course, that we're going to add another position. It'll show up in energy, and we can revisit next week. We did a broad market look at the S&P, the NASDAQ 100, and the Russell 2000 before reviewing our trades that just got stopped out last week, and with which the reminder once more, it's difficult to be on the long side in a volatile market, but it's imperative that we trade to our comfort, which is what we strive for here. It's why the process we go through is so important. And I hope that's good for all of you, because on our end of things, the key is the discipline to stick to the plan, and we keep coming back each week to do just that. So with that, I will thank you all for joining. Thank you, Connie, for managing the chat for us. Make sure you're following both of us on X, Connie Hill CS, Kevin Horner CS. If you liked this discussion, hit that thumbs up button for me down below. We, of course, get this reviewed. It'll be in the archive early tomorrow, and that'll help us out on a replay basis on the YouTube side. And maybe we can get even more viewers to see a class like this one. So with that, have a fantastic Wednesday. And don't forget, or pardon me, fantastic Tuesday. Tomorrow, Wednesday morning, Trader Talk at the opening bell with me and Brent Moores. I look forward to seeing you then. Have a great night, everyone.